Hi, everyone. Marty Becker here, owner and founder of Atlas Financial Strategies, where we specialize in asset-based long-term care insurance, guarantee retirement income, and asset protection. In this short video, we're going to be answering the question, can I use my IRA to fund a long-term care insurance policy? And the short answer is yes, you can. You can use qualified money to fund an asset-based long-term care insurance policy. Now, what is qualified money? Any money that is tax deferred, meaning you did not pay taxes on the money when it went into the account, and you have not paid taxes on any of the growth, is called qualified money. And that could be a 401k, it could be a 403b, a 457, an IRA, et cetera, et cetera. It doesn't really matter what type of account it is. If you haven't paid any taxes on the money, it's qualified money. And you will be forced to start paying taxes on that money when it is withdrawn. For most of us now, it's going to be at the age of 73. Eventually, that will go to age 75. I think in 2035 is the current rule. However, there is a stipulation that allows you to use tax-deferred money towards a long-term care policy. As of right now, there are only two companies that I know of that allow you to use the qualified money and keep it deferred until you go on claim. So there's several more options that allow you to use qualified money, but what they will do is they will actually dequalify it over a period of time, meaning over a scheduled course of time, you will pay taxes on that money every year, even though it's still sitting in the long-term care policy. And then once you go on claim, all of that money is completely tax-free. Now, some people don't like that, and that's okay. You have this other option where all of the money stays tax deferred until you go on claim. But keep in mind, when you start receiving your benefit check, you will pay taxes on that money that you originally put into the policy. Once you go over the original amount that you put into the policy, everything after that is completely tax-free. So that could be very beneficial if you have a lifetime long benefit. Here's another cool thing to keep in mind. If you have an IRA and for some reason you don't qualify for long-term care coverage, you can still use your IRA to pay for your spouse's long-term care policy. So that's a great thing. And I want to tell you, there's a big secret that a lot of people don't know about. I guess it's not really a secret because it's actually written in the tax code, but most advisors don't even know about it. So here it is. If you have a non-qualified annuity, meaning you paid the taxes already on the money that you put into the annuity, you can exchange it for a Pension Protected Act long-term care policy and not pay any taxes on the gains during that transfer of funds. Okay, so that's not totally uncommon. Here's where it gets good. When you go on claim with the long-term care policy that you funded with the original annuity, you still don't pay any taxes on the money as it comes out. Now, that's huge if you have a non-qualified annuity that's just sitting there and you don't need the money and you want long-term care. So that's really the only strategy that I know of that allows you to double dip on the tax breaks. So that's a big deal to keep in mind if you have a non-qualified annuity. And there are other benefits out there. If you itemize your tax returns, you can deduct the expenses of the premiums. Most people just take the standard deduction. So that's probably more beneficial to those of you who own like an S Corp and things like that, but it's worth noting in this video series. Anyway, I hope that helps, and I want to thank you for taking the time to watch this video. And I want to highly encourage you to watch the rest of this video series, then book a short phone call at atlasannuity.com so we can design a customized strategy just for you. Again, this is Marty Becker, wishing you all the best.